Tricky topics. There are plenty of them in FR, aren't there? One of the trickiest, certainly one that the examiner thinks that students find the hardest, is actually analysis and interpretation. There is always some analysis and interpretation in your FR exam, and you need to be equipped to deal with it. Now, I know that most students are more than happy to do the number crunching side of things, the actual ratio calculations. The trickier bit is actually analysing that and analysing what the ratios mean, particularly in the context of a given business. So that's what this video is all about, helping you with those written analysis questions. Now, the idea of this video is to arm you with some ideas for what to write in an analysis question. However, how to write it does remain really important. So I just want to use this example to show you a few things really to remember in terms of how you write. So this is entirely made up, by the way. First thing to point out here is that when you write, you should include headings. So one of those might be position, one of those might be performance, for example. And then you should also try to chunk this down further using subheadings. So as you can see, I have used the individual ratios that I am talking about as my subheadings. It doesn't really matter. What we're trying to do here is lead the marker through your script. Show them that you have covered everything that needs covering. Okay, what else can I tell you? Well, in terms of how I have written, notice that these are short, sharp paragraphs. Within the first paragraph, note that there are a couple of sentences. So I'm going for the shorter, sharper sentences, trying to get the point across. So I'm trying to avoid waffle. In terms of both of my margins in this particular case, I have started there with a fact. So gross profit margin is improved from 27% to 35%. The same sort of idea for operating profit margin. So the fact, what has actually happened. Now that is not what's going to score for me. What's going to score for me is developing that fact. So I am suggesting an approach that I always call fact plus ELF. What does ELF stand for? It stands for explain, or link, or think about the future. So if you can say something relating to your fact, which falls into one of those categories, that's how you're going to access marks. The examples on this slide. First of all, the gross profit margin, we've got an increase there. Notice that I've written it as improved rather than increased because that already starts to show analysis skills. I understand what the gross profit margin is. But then I've gone on to explain this may be related to entering a new geographical market and charging higher prices to customers in the new market. So that's an example of explain. What about link? If you drop down to operating profit margin, the operating profit margin has again improved, is a better word than increased. This is in part due to the increase in gross profit margin. So that is my link. The idea with link is you link to another part of the financial statements or another ratio. What about future? Down here in the operating profit margin section again, the second paragraph, operating profit margin would be higher if there weren't redundancy costs. These are a one-off cost, won't exist next year, meaning operating profit margin should improve again. So that's me getting out my crystal ball and thinking about what will happen in the future. So if you can say one of those things, that's how you're going to access marks. For every extra thing, you're going to access some more marks. Now, just to reiterate, I already said this is entirely made up. What is written on this page is entirely made up. When you are writing your exam answer, you must reference the scenario. You must reference the information you have been given in order to explain movements or differences in ratios. Now what I want to do is move on and look at some, not all, but some ratios so that we can just think about what you would write. And I think that really understanding ratios is crucial to making sure you know what to write. So the first ratio that I have picked is one that comes up quite a lot, the gross profit margin. Now remember, you might be asked to calculate this, or you might be given a gross profit margin. Regardless of which the examiner's approach is, it's really important that you remember the calculation. You need to know that calculation so that you can talk about the margin, even if it's given to you. What does gross profit margin mean though? Well, 40% margin is my example there. That means for every dollar of revenue, there's 40 cents of gross profit. Now, when you are trying to explain why a margin has moved, that's on the assumption that a question asks for a comparison year to year. Of course, it could be comparing one company's margin with another company or comparing with industry averages. But regardless of the style of question, if you want to explain a movement or a difference, I think a really important thing to do is go back to this calculation and think about those two elements completely separate. So you've got your gross profit and you've got your revenue. And what we're basically saying, if the margin is different or has changed, is that one of these, if it's changed in particular, has moved potentially, but the other has moved disproportionately. And what you need to do is explain why it is disproportionate. And that's really true for all ratios, because all ratios are one figure over another. And if they move, it's because one thing's moved more than another. One of those items has moved more than another. Let me just show you an example of what I mean using gross profit margin. Well, let's again use some entirely made up figures. So revenue 500,000, cost of sales 400,000 gives me a gross profit of 100,000. So if I calculated my gross profit margin, that would be 100,000 over 500,000 as a percentage, which of course comes out at 20%. Now let's imagine everything's gone up by 10%. So revenue up by 10% becomes 550, cost of sales up 10% is 440, 550, less 440 is of course 110. 110 is my gross profit over 550. As a percentage, yet again, that comes out at 20%. So you can see what's happened there is revenue and cost of sales have gone up proportionately. Because they have moved proportionately, my overall margin has not changed. Now let's say that revenue goes up 10%, so that becomes 550 of course. However, cost of sales does not change, so that remains at the original 400. Gives us a profit of 150, obviously 150 over 550 is my margin at 27%. So in that case, my margin has increased because revenue's increased disproportionately to cost of sales, which in fact hasn't increased at all, of course. So then your job is to explain why revenue has gone up, but cost of sales hasn't. Now, whenever you're talking about revenue movement, remember that two things could have happened. It could be a combination of both, but this could be a case that prices have gone up, the selling price has gone up, but we're selling the same amount of goods. Or it could be the case that price hasn't changed, however, volume has gone up. So then just think it through. If the price has gone up, it might be the case that cost of sales, well, the cost of our goods is just the same as it always was. Nothing has changed. However, this company's in a new market, has a new customer, or has maybe just placed itself in a different position in terms of premium product or whatever, hence pricing going up. If volume has gone up, it might be the case that cost of sales has not gone up proportionately for the simple reason that bulk buy discounts have been achieved because that much more is being bought in the way of raw supplies. So break it down to think about this. That's what I mean when I say think about the construction of the ratio when you are explaining it. Think about this moving in proportion. Why would one item have moved when one hasn't? So let's think then in summary about what might explain changes in gross profit margin. And I am thinking in the context of changes here, but of course you can adapt this kind of narrative to fit a comparison of one company with another. So an increase could be due to an increase in the average selling price of each item. Don't just say that though, say why that might be, obviously based on the scenario that you're given. So it might mention there's a new market, it might mention a new customer. Or it might mention that there's a limited supply of whatever is being sold. In other words, demand is higher and you can charge a higher price. An increase in gross profit margin might be explained by a reduction in average cost per item. Again, why might that be? Always ask the question why in analysis questions. It could be there's a new supplier, something we've just mentioned, a bulk buy discount. The third reason for a change, an increase in this case in gross profit margin, is a change in the product mix. Let's say our company has only ever sold ballpoint pens at a 40% margin. Suddenly they are also selling pencil cases at a 60% margin. So the fact that some 60% margin goods are now being sold is going to pull the overall margin up from 40. What about a decrease? Again, it's driven by three things. It's going to be a decrease in selling price, an increase in cost per item, or again, a change in product mix. But again, use your scenario to try and say why that is. So there might be more competition pushing prices down. There could be a new supplier charging higher costs for raw materials, possibly some supply issues, again, the whole idea of supply and demand. It could be that our company is now buying better quality materials so that it doesn't have as many returns. Now, when you are talking about the reason for a movement in gross profit margin, one thing you should not mention as a standalone point, and students do this, so please don't let that be you, do not say that it is explained an increase or decrease by a change in sales volume. It doesn't matter whether my company sells one ballpoint pen at a 40% margin or 100,000 ballpoint pens at a 40% margin, the margin will still be 40%. So volume you can only use as an explanation if you are going to link it to reducing prices to increase volume or possibly achieving economies of scale. In terms of the rest of the financial statements, what can you link to? Well, you might spot there's a lower margin, for example, but revenue is higher, in which case it suggests prices have been cut in order to achieve that growth. Sales returns, I've just said if costs have gone up, it could be in order to buy better quality materials, which would of course reduce sales returns. So those are the kind of things we're looking for linkages. In terms of the future, use the scenario if it mentions potential new customers, potential orders, new products, maybe moving into a new market or some increased competition, then you have something to say about their impact on future margins. Let's move on. It's certainly worth talking about ROCE, return on capital employed, because it is quite popular in the exam. Calculated as operating profit over capital employed as a percentage. What is capital employed? The easiest way to calculate capital employed is to take your total assets less current liabilities. But what that basically tells you, what that leaves you with, is your long-term liabilities plus equity. In other words, really your long-term funding. You come out with a percentage. What does that percentage mean? It's really a measure of how efficient the management are, how good the management are at using the resources at their disposal. So a 30% ROCE means for every dollar of capital employed, every dollar available to management to use, they manage to turn it into 30 cents profit. Now, the easiest way and possibly the best way to analyse return on capital employed is to break it down into two further ratios. The first of those ratios there is the operating profit margin, operating profit over revenue. What does that mean? Say the margin is 22%, it means for every dollar of revenue there is 22 cents of operating profit. But to get to ROCE, that is multiplied by asset turnover. Asset turnover is calculated as revenue divided by capital employed, defined as we've just seen. That does not come to a percentage, that is just an absolute figure. So let's say the absolute figure was 5. What does it mean? It means for every dollar of capital employed, revenue of $5 is generated. In other words, how well do management generate revenue with the assets at their disposal? Now, why is it useful to break down ROCE into those two ratios? Because you can then analyse these two separately. You can identify which one of them is responsible for a movement in ROCE and go into that in more detail. So say the ROCE 1 year was 40%. And that was made up of a 20% operating profit margin and asset turnover of 2. The next year, ROCE has dropped to 34%, and that is made up of an operating profit margin of 17%. However, asset turnover is still at 2. Then you know that you have to home in on a discussion on the operating profit margin. And you can go back to the idea that we've just discussed, whereby we say these two figures, operating profit and revenue, have moved disproportionately. Why is that? And don't forget, in discussing operating profit margin, refer back to the gross profit margin, because that has a knock-on effect. But also look at one-offs in operating expenses. Now, if asset turnover had changed, then some discussion of why that is needed. So go back to this basic principle of revenue and capital employed. Have they moved disproportionately? The idea is that if, let's say, 10% extra assets are bought, then those should be able to generate 10% extra revenue. Think about why that might not be the case. So, for example, it could be a timing issue. In other words, assets have been bought, they are included in capital employed, but they were bought at the year end. They have not yet had time to kick in to revenue. It could be that actually capital employed now includes a revaluation surplus. Last year, revaluation was not a policy. This year it is. Well, in that case, we may still have the same number of assets. So how would they possibly generate more revenue just because they've been given a fair value uplift? Now, of course, so far we've homed in on movements in capital employed. You might, of course, be talking about the fact that revenue has, for example, shrunk while capital employed has remained the same. So again, there you can go back to the discussion that we mentioned earlier, talking about volume, talking about pricing, discussing markets and so on, depending on the information you're given in the scenario. Now, before we leave ROCE, let me just show you how useful breaking it down into component parts can also be if you are comparing two different companies. Here I've got company A and company B. You can see they both have a ROCE of 45%, so look very comparable. However, let's say that company achieves that by having a 15% operating profit margin and an asset turnover of 3. So it makes a 15% margin on the goods that it sells, so a pretty decent margin, but actually it doesn't generate a lot of revenue for all of its capital employed. On the other hand, company B in the same industry makes an operating profit margin of 5% and its asset turnover is 9. So that makes a much lower margin, and actually it generates much more revenue for its assets, for its capital employed. So that tells us that these two companies can get to the same outcome by employing what are essentially very different strategies, probably. Now, if you think of both of these companies in the context of retail, let's say fashion retail, then company A is making higher margins, but obviously has a lot less revenue for its assets. So that is probably more of a high-end retailer, maybe located in a really nice city centre location. That's why it doesn't make much revenue for its assets, because the asset value is so high, but it can charge the higher margins. On the other end, company B is much more of a mass market retailer, maybe in a retail park, something like that, where assets, properties are cheaper. It can generate much more revenue for its assets, but it does charge those lower prices and so has lower margins. So two very different strategies, exactly the same outcome. So just be aware of that if you are comparing different entities. Well, now let's move away from performance ratios and touch on some position ratios. And I thought I'd pick up on the working capital days here, for which, of course, there are 3 different calculations. So the first one there is your trade receivables days, trade receivables over revenue times 365, of course, being the number of days in the year. That tells us how long on average it takes to receive payment from a credit customer. We have inventory days. Remember, inventory sits over cost of sales because inventory is measured at cost, doesn't include the profit margin. Therefore, it's correct to sit it over cost of sales rather than revenue. Times 365. That shows us how long on average, of course the number coming out the other end is days, how long on average is inventory held from purchase to sale. And finally, trade payables days, same type of calculation. Again, the amount you owe is based on the cost of goods to you, therefore it sits over cost of sales, and that's how long on average it takes our company to pay a supplier. Now, a word of warning with these ratios: in all of these cases you have a soft P amount on the top of the ratio and you have a profit or loss amount on the bottom of the ratio. That means that the top figure could of course be a little bit skewed by something that's happened at the year end, whether it is a year end payment to a supplier or receipt from a customer, maybe a delayed delivery. So that year end figure not necessarily indicative of the whole year. So that's just a little bit of a warning. But beyond that, in each case, if you have got a movement in any of these, it is your job once again to look at why one figure has moved disproportionately from the other. Now, when you're dealing with receivables and payables, you can of course refer back there to the credit periods that have been allowed and whether those have shifted, which could be related to new suppliers, new customers. But one thing I want you to really remember here is that there could be a good story or a bad story behind an increase or a decrease in days. Let me show you what I mean using inventory as an example. So up at the top there, I've just got the general what could explain a movement up or down. But if we look at the increase in days and the decrease in days, initially, it's very natural to think an increase in inventory days is really bad. It means that there's a lot less cash in the business, for example. There could be stock hanging around which is old. And sure enough, my first two reasons for an increase in days are what I'd call bad reasons there. So it could be that demand has fallen. That could be related to increased competition. It could be that some of the goods in the storeroom are actually really out of date, out of fashion. If it's a fashion retailer, could be faulty, so we can't sell them. However, don't forget there could be a good side to this. That increase in days could be because our company has been really clever and has bulk bought goods because it knows it can get a better price, maybe ahead of a big price rise it knows is coming up. Or it could be that it's just received a big order for next year, so it's gearing up, it's building up its inventories ahead of that. Equally, a decrease in days, it could be kind of the bad side of it, that there are supply issues. Our company just can't get its hands on the raw materials it needs or the goods it needs, and therefore it's affecting the business. However, on the brighter side, our company might be moving towards a much more efficient management of inventory system. So something like just in time. And of course, that would mean that things like storage costs would go down, insurance costs would go down, the general holding costs would go down. So have a good impact on the business. So just be aware the two sides of the coin with working capital days when you are trying to explain a movement. Again, as before, we have linkages here. So for example, inventory, if days are up, that is going to mean higher insurance and storage costs. So you could mention that as a future impact, or you might actually be able to spot it in the profit or loss for the current year. If days are down, it could well mean that more deliveries are having to come in to replenish goods, and that means that delivery in costs would be up. So generally, I find that students are quite confident with working capital days, but the two things to remember there, first of all, as we've always said, think about why items aren't moving proportionately, and secondly, don't always attach yourself to this being a bad thing if days are increasing. For example, there could be a good reason behind it. So an increase in receivables days, for example, could be a big new customer that has been incentivized by extended terms. So that was just a touch on a few key ratios that we often see to explain how to approach what to write. So in summary, state your fact, but then make sure you take it further. To access your mark, you must take it further. And you might do that by explaining what has happened with reference to the information you've been given in the scenario, by linking to other movements in the financial statements or in related ratios, or potentially by thinking about the impact on the future. Again, referring back to information that you've been given in the scenario.